Hey everyone, Jerome Powell speaks in just a moment, and we got a statement just out seconds ago. Federal Reserve Chairperson Powell says Trump tariffs bigger than expected, risking higher inflation and slower growth. Too soon to say what the appropriate path for monetary policy will be, exactly as we expected. Powell's not going to do anything. He's not going to bend because he's got risks of higher inflation, de-anchoring inflation, and pretty good job numbers this morning. You got to give it to him. Good job numbers this morning. Fed well positioned to wait for greater clarity before considering adjustments. Tariffs likely to raise inflation in the coming quarters. More persistent effects are possible. It's becoming clear that tariff increases will be significantly larger than expected. The same is true of the economic effects. This is not good. In other words, Powell, as expected, hey, we can't do anything here. As a result, he says here, the outlook is highly uncertain with elevated risks of higher unemployment and higher inflation. The uncertainty is high. Downside risks have risen. The economy is still in a good place, says Powell. Data show solid growth in the labor market in balance. Inflation closer, but still above the 2% goal. Surveys show dimming expectations, higher uncertainty due to new Fed policies, especially trade, and the Fed is closely watching tension between hard and soft data. Unemployment rates still in a low range, job market not a source of inflation, and progress towards the Fed's 2% goal has slowed. Now, what do you have? Well, you have, as expected, Powell basically is going to sit there with his arms crossed and do nothing. Now, the event where Powell speaks starts in just a moment, so we're going to, obviously watch Federal Chairperson Jerome Powell not only read us this, but then go into usually some form of a Q&A session, and we'll be able to get a little bit more color, and we'll kind of get to see what his demeanor is like. Does he look like he's panicking yet? The odds are no. My take is one of the best times to buy stock is when the Federal Reserve is panicking. Doesn't seem like we're there yet. And so here we go. Let's get into it.
I'm sure that this room full of reporters does not lack for questions to ask, and before answering a few of those, I'll briefly summarize the outlook for the economy and monetary policy.
This is the statement.
At the Fed, we are squarely focused on achieving the dual mandate goals that Congress has given us of maximum employment and stable prices. While uncertainty is high and downside risks have risen, the economy is still in a good place. The incoming data show solid growth, a labor market in balance, and inflation running much closer to, but still above, our 2% objective. After a couple of years of solid growth, many forecasters have anticipated somewhat slower growth this year. The initial reading for first quarter GDP will be released later this month. The limited hard data are consistent, though, with a slower but still solid growth outlook. At the same time, surveys of households and businesses report dimming expectations and higher uncertainty about the outlook. Survey respondents point to the effects of the new federal policies, especially related to trade. We are closely watching this tension between the hard and the soft data. As the new policies and their likely economic effects become clearer, we will have a better sense of their implications for the economy and for monetary policy. Looking across many indicators, the labor market appears to be broadly in balance and not a significant source of inflationary pressure. This morning's jobs report showed the unemployment rate at 4.2% in March, still in the low range where it has held since early last year. Over the first quarter, payrolls grew by an average of 150,000 jobs per month. The combination of low layoffs, moderating job growth, and slowing labor force growth has kept the unemployment rate broadly stable. Turning to the other leg of our dual mandate, inflation has declined sharply from its pandemic highs of mid-2022. It has done so without the kind of painful rise in unemployment that has often accompanied periods of tight monetary policy that are needed to reduce inflation. More recently, progress toward our 2% inflation objective has slowed. Total PCE prices rose 2.5% over the 12 months ending in February. Core PCE prices, which exclude the volatile food and energy categories, rose 2.8%. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters. Reflecting this, both survey and market-based measures of near-term inflation expectations have moved up. By most measures, longer-term inflation expectations, those beyond just the next few years, remain well anchored and consistent with our 2% inflation goal. We remain committed to returning inflation sustainably to our 2% objective. Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. It is not our role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary policy in a way that best achieves our dual mandate goals. We have stressed that it will be very difficult to assess the likely economic effects of higher tariffs until there is greater certainty about the details, such as what will be tariffed, at what level, and for what duration, and the extent of any retaliation from our trading partners. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored, on the size of the effects, and on how long it takes for them to pass through fully to prices. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy. We understand the benefits of a solid economy where workers can find jobs and inflation is low and predictable. We also understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. That is why we at the Fed will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Hey, I'm gonna turn off those ads. I didn't know they were on. That was my fault. Sorry about that. Let me turn that off. YouTube interjects them and they're annoying.
Thank you for being here. This feels like quite a moment to be speaking with you, and I want to thank you for your time. He's got it. I want to thank you for being here, and...
Okay, there we go. I disabled them. So let's listen to the Q&A that's coming up now. This is obviously going to be the important part versus the statement. We didn't actually expect him to say that he was going to, cut rates because Donald Trump asked him to, obviously.
Just fine, thank you.
Care to elaborate?
So far, so good.
Chair Powell, yes, thank you so much for being here and taking our questions. You were talking about the economy as being a very strong economy. You characterized inflation as coming down, employment as being very strong still. However, President Trump, earlier this week when asked about the market volatility we've been seeing, said the volatility was, quote, to be expected. This is a patient that was very sick. We inherited a terrible economy. A lot of voters did and do agree with that assessment, or at least in part. I'm wondering how you would respond to that assessment and the disconnect between the story of the data and the way a lot of people are feeling about the economy.
Sure. So let me just be clear at the start. I make it a practice not to respond to any elected officials' comments. So I don't want to be seen to be doing that. It's just not appropriate for me. But the situation, I think, is this, and people, when they're surveyed, they are unhappy about the economy. That seems to largely reflect the increase in the price level that happened when inflation was high, 2021, 22, and 23, largely. Inflation is now back down to much more normal levels. Unemployment is low. The economy has been growing, but people are still experiencing that high price level. In other words, prices don't go down. They know they're paying much more for the basic necessities of life, and they're right that they are, and they're not happy about it, and they're right not to be happy about it. So I think that accounts for the negative sentiment. We, of course, we're looking at inflation, which is the change in prices, and we're seeing that that has come down quite a bit, and that, you know, unemployment is actually low. It's sort of very close to measures of maximum employment, and the economy's growing. So all those statistics are good, but you know, the price increases of the past few years are weighing on people's budgets.
So I'm from Milwaukee, and I've been talking to business leaders, executives, and consumers in our community, our region, for the last few weeks, mostly before this week's news. Chairman, they're troubled and they're nervous. One business owner told me, if there's a hint of a recession, we're cooked. And he asked me to share that with you. What's your response?
So I guess I would say, let's start with the fact that the incoming data right through this morning's employment report, which admittedly is from roughly a month ago, the week of March 12, they took the data in. It still shows us a solid economy. Unemployment's still low. I understand the uncertainty that's weighing on people. You ask about a recession. We don't make a probability forecast of how likely it is for there to be a recession, but many outside forecasters do, and many of them have raised the likelihood, albeit from very low levels. It's not something that anybody now is forecasting, or some people are starting to. And so there's not much more I can say about that. I realize that the uncertainty is high, you know, what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We still don't know where that comes to rest, though, and we're just going to have to see that through.
At a congressional hearing last year, one of the U.S. representatives said that you were pretty boring, and you thanked him and said that you considered that a very high compliment.
It's actually a good thing.
And in fact, I feel like it's one of the roles of the Federal Reserve, especially since the housing crisis, to be kind of a ballast, especially in the face of the volatility of the markets and the dramatics that we can experience.
They're not going to help you pump your stocks, though, right now.
Very steady, no surprises, very reliable. In a moment like this, which also has a lot of drama and unpredictability, but it is not necessarily from an economic crisis. It's by design, it's political. How do you see your role in this moment?
So I think all of the values that you touched on are, in fact, the values that we try to live by. You know, we're driven by, you know, analysis and careful thought and discussion and debate and the merits of things. We try to stay as far as we can from the political process. We don't look at political cycles or things like that. So, and I think people expect that from us. They expect us to tell the truth, and that's what we're going to do.
Let's go.
But at the same time, we don't want to be part of the broader political discussion about the wisdom of policies that are not assigned to us. We're not responsible for trade policy, immigration policy, fiscal policy. So we don't comment on those. Decisions are made by others, and what we do is we use our tools to try to achieve the goals that Congress assigned us, which is maximum employment and price stability. So I think that over time we're a source of calm, rational analysis and also of stability. That's really what the business that we're in is, providing financial and macroeconomic stability to the public. That's really our purpose.
So how can businesses and individuals and the Fed make plans for the future when so much is being dictated by the actions of a single person? And do you see yourself as the consoler-in-chief on economic matters?
No, I think, take a step back. What's happening is, as I mentioned, the new administration is making, you know, significant policy changes in trade, immigration, fiscal policy, and regulation. And you're still just a couple of months into the administration, and that process will take place. And at a certain point, the new policies will be on the table. They will be having the effects they're going to have on the economy, and uncertainty will decline. Right now, there's a lot of uncertainty about where all that's going to sort out, the forms it will take, and what the economic effects will be. If you fast forward a year from now, the uncertainty should be much lower. The actual effects of the policies should then be pretty manifest and clear. So I think I understand why it just is highly uncertain, both what the policies will turn out to be, exactly what they'll turn out to be, and also what their effects will be in the near term. We just have to go through that process, and it is just kind of a manifestation of our election cycle and a new administration coming in with new policies.
Notice no mention of transitory tariffs yet.
We are in a period where things have not settled in yet, and that the Federal Reserve and you as chair are very projection, data-driven, policy-driven. How do you handle a moment like now? I mean, can you tweak your plans and projections? Do you just do you have to reset them?
So, what we've had since in the last few months is, from the staff, has been a placeholder. Rather, they wouldn't call it a forecast because it's so uncertain. They call it a placeholder. And that's kind of how we've been thinking about it. So it's a good time to take a step back and let things clarify. That's why it's just too soon to say what the appropriate monetary policy response will be to these new policies. It is just too soon to say. We can't say with any confidence today. So that's what we're doing. We've taken a step back, and we're watching to see what the policies turn out to be and the ways in which they will affect the economy, and then we'll be able to act. Fortunately, our policy stance is in a good place for us to do that. We're probably moderately restrictive, let's say, so it's not really tight policy, but which is appropriate since inflation is a bit above target. So we think we're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments.
Business owners in Wisconsin have told me that they can't make their plans. They want to expand. They want to build a new facility. They want to hire or do whatever the future calls for. They say, we're trying to look around the corner. We're not even sure where the corner is, and we're not even sure what's around the corner. Sounds like they're in the same position as you are a little bit.
No, we hear the same thing. Of course, we have an incredible network of contacts with businesses and also universities, nonprofits, all different sectors, through the reserve banks and also through the Board of Governors. And that's what we hear. But again, it's a process. We're going through it, and I think we will know when we know what the policies are exactly and what their implications will be for the economy. That will all become clear, and I think that'll be a time when people can make decisions. In the meantime, though, I get it. We're hearing that a lot from people, and we are kind of in the same place, which is waiting for clarity about what our policy path should be.
It might be months away.
We'll have to see.
Yeah.
As you're talking about placeholders right now and having something in the place when there's so much that we don't know, it does occur to me that this is not the first economic shock that you have steered the markets and the economy through. Obviously, there was COVID almost exactly 5 years ago. It seems similar in certain ways with a lot of uncertainty, a lot of shock, also potential disruptions to prices and to supply, which is very much in the Federal Reserve's wheelhouse. I mean, from where you sit, can Liberation Day be compared to kind of the economic effects of COVID? Are they totally different, somewhat related?
I think each situation is different. There was COVID. There was also then, in the response to COVID, then there was high inflation, and then there was soft landing, and now we have new administration and changes in policies. And every situation, it kind of rhymes, but it's not exactly the same thing. And so in this situation, what we face is what I mentioned in my remarks is you actually have risks for higher unemployment and higher inflation, and that's difficult for a central bank because our tools, which consist of interest rates, either slow down or speed up the economy over time. And higher unemployment would call for speeding up the economy, and higher inflation would call for slowing it down. So you can be in a situation how far each of the two variables is from its goal, and we ask ourselves, how long would it take to get back? And we weigh those things and make a decision about what to do. But there's no question that's a different situation, very difficult situation. When we faced high inflation, it was painful for the country, painful for the people that we serve, but we knew what policy needed to be. We knew we needed to raise rates quite a bit. During the pandemic, we knew what we needed to do. It was very clear the direction that we needed to take with force, and we did.
it's almost a situation potentially where the dual mandate is at odds with itself.
The two goals are, as we say, in tension, or they may be. I'd say that's not what we're seeing right now, but it's the effects at the margin right now would be for higher inflation and perhaps higher unemployment, but that's a marginal effect. I would say you're not in a situation like we were in the 1970s where the two goals were really both pulling in opposite directions and required. That's where, it's just very hard for a central bank to be the answer to a situation like that. But that's not the situation we're really in today.
One of the questions from the audience that we had is, if unemployment takes off and inflation takes off, which lever do you go for? Which lever do you, what do you do?
So we actually have we have a document called our consensus statement, or the longer version is Statement on Longer Run Goals and Monetary Policy Strategy. And the 6th paragraph of that actually contemplates when the two goals are in tension. And what it says is, think about how far each variable is from its goal, and think about how long it would take for each to get back. So in a way, it's an equation. You're comparing two quantities which each have two variables. And then you say, you look at that and you think, what do we need to do? And typically this doesn't happen very often, but if one of them is further away, then you would focus on that one. In the case of high inflation, they actually both pointed in the same direction. The labor market was overheated and inflation was very high. So both of those called for tight monetary policy. This could be different, but again, we're not actually facing that today.
Basically, really quickly, if unemployment skyrocketed and inflation is like close to 2%, like 2.5% or 2.8%, they're going to go rescue the labor market. But by then it might be too late, right?
Very profoundly human, as Jim has been pointing out. Jobs, I think, and prices are probably the two most human pieces of data, and certainly in our day-to-day experience, probably the things that loom the largest. How do you reconcile those two things when you're looking at the data, like both the global markets and knowing that the data represents a lot of lives and jobs and egg prices and things like that?
So I think at the Fed, we always keep a focus on the people that we serve, and we know and are very conscious daily that the things that we do have a real effect on people's lives. We know that, and it really does focus the mind. And I think if you talk to people at the Fed, there's a very strong commitment to serving the public as well as we possibly can. Economic events are just very, very unpredictable at times, and there are shocks that you can't see coming. But nonetheless, our job is to, whatever happens, use our tools to bring the economy back to stability, back to price stability, back to maximum employment. And that's what we do. But you're right. We try to keep everybody in the room with us when we're thinking about what to do.
So in response to the last round of tariffs, Harley-Davidson, which is based in Milwaukee, moved some production to Thailand. Now the company might be whipsawed again by the new tariffs. It could be really devastating for sales, for employment, for the future of that company. But a lot of companies are in that same position. And what do you say to companies like Harley-Davidson and their workers?
So it just isn't, I really want to stick to our knitting. I mean, we have this great thing called our independence of monetary policy, and that's critical for us to be able to do our job. But for us to keep that independence, we need to not succumb to the temptation to want to be a player on issues that are not assigned to us. And trade policy is one of those. There are many, many issues that people love to try to pull us in on, almost every issue, really. And we just need to stick to our knitting, not get pulled into those things. And so trade policy is a classic one. Energy policy is another. Climate change, immigration is not really, although all of those things have economic implications, and it gets argued that way. But if we treated those as our job, the case for our independence would disappear. So I really can't comment on, we hear the same stories like that, but honestly, the policymakers who are charged with that, they're probably hearing the same stories too, and they're reaching a judgment about what's in the best interest of the country in the long run. That's what they are doing, I guess, and that's, so it's not for us to comment on that.
What happens inside the Fed at a moment like right now, when there's so much change and quite a bit of uncertainty, when you're watching things unfold? What does that look like practically speaking? What are people doing inside the building?
So I'm very proud to work with the people I work with. I can tell you that in times like this, or times like the pandemic, where the global financial markets were shutting down, the global economy was shutting down, people step forward and they say, "We've got this." These are career people who were here for the global financial crisis. They've got 25 years, 35 years of experience with crises, and they step forward and it's just incredible what they can do and how good they are. It's a great honor to work with them. So right now isn't that situation. We have the situation we have, so our trade people and our inflation people and our macroeconomists are all working hard to kind of digest the news of this week and try to filter that into the forecast that they'll make. And policymakers are doing very much the same thing, and we're reading everything we can about what's happening and lots of outside analysis too. We don't have an FOMC meeting until May 6 and 7, so that's really a process that lasts several weeks. And we're not quite at that stage yet, but we're kind of thinking ahead to that and working through all of that. I will say though, it feels like we don't need to be in a hurry. It feels like we have time
Really?
to. Yes. It feels like we don't. No, I mean it's like I said. You have inflation is going to be moving up and growth is going to be slowing, but it isn't really. To me, it's not clear at this time what the appropriate path for monetary policy will be, and we're going to need to wait and see how this plays out before we can start to make those adjustments.
Question from the audience. One of our CEBU members is, are you in contact with other central bankers in other countries at a time like this?
Yes, pretty frequently. Absolutely, I am. And the same was true during the other crises I've been through. Not only that, though, we do meet very regularly. The IMF World Bank meetings here in Washington twice a year. We go to Basel multiple times a year to meet. That's all central bankers. And there are also G20 meetings, G7 meetings where the central bankers are there. So we're kind of regularly meeting and talking. And when we're not doing that, we're also texting each other.
Is there a group chat?
Signal chat.
I'm not at liberty to say. No.
That's a good one.
No, there's not.
And have you talked to those central bankers this week?
Recently, yeah, I didn't want to get too specific about this, but yes, I have.
What's their sentiment? Can you characterize that?
I'd rather, again, I don't comment on what my international colleagues say, or it's not appropriate. But we're talking about events. We're talking about the implications for the economy. We're discussing what we're hearing from markets and from business people and for from the elected governments too. It's all the things you would expect us to be talking about on a regular basis. It's one of the best things about this role is that the central banks have a lot. We're all non-political, so we think about things in quite similar ways, and they're real bonds. We're not lobbying each other ever on policy. It's just never. That's just not a thing, because we do our policy here, they do their policy there. But we develop really, really good relationships and bonds with them, and it's one of the real pleasures and benefits being able to talk about this, just not only with the great people at the Fed, but also with the leaders around the world.
I mean, it's interesting because it is a job of enormous responsibility and power, but it's also a job. How would you characterize the job of Fed chair? Like, how is it as a job?
Honestly, that's what it is. I really feel just like another person doing that job.
Really?
Yeah.
You just like...
That's how it is. I'm doing a job. I have a job to do. I actually really like the job. I like it a lot. I enjoy it. It can be stressful at times. Nonetheless, incredibly interesting, great people to work with, really important. What more could you want? But that's what it is. And, I'm blessed by working with great colleagues who are really committed to getting it right. I mean, fully appreciate how important it is that we get it right. And do everything we possibly can to bring the best thinking, the best analysis, and debate things, over and over until we feel like we're in the right place. At the same time, there is no certainty in this. You can be wrong because the economy can zig when you thought it was going to zag.
So your term as Fed chair ends about a year from now. What do you think about your job security?
I fully intend to serve all of my term.
Excellent. I mean, as we're getting close to wrapping up, I did want to ask something a little bit out of the box. I think because you do have a position of such great responsibility, people are very curious about you, and I think people tend to read into everything a Fed chair does. Small gestures, word choice. I know it's part of our jobs in this room to pore over every word you choose. I did want to ask about one thing that I've wondered about for years, which is your tie.
Come on.
You always seem to wear a purple tie, and every time I think I've seen you, you've worn a purple tie, and I'm wondering if there's significance to that?
Well, at the beginning, the only significance was that I like purple ties.
Yeah, of course.
But I will say, so then the next press conference, I reach for a blue tie or a red tie, and I go, maybe not, And
Political.
so I wind up wearing purple ties. And then it becomes a thing, and now I definitely wear purple ties all the time.
Okay.
But I felt like, it just felt a little awkward to be wearing one that was identified. We are strictly non-political. I can't stress that enough. We are not, it's not that we're bipartisan. We are non-political. We don't do that. And so purple is a good color for that. That's all. Plus, I like purple ties.
Sorry, I didn't give you a purple guitar pick. I have one other Milwaukee question that I overlooked here, but in Milwaukee and other parts of the country, the housing market is out of whack. In our market alone in southeastern Wisconsin, there's 5,000, the market's out of whack by like 5,000 houses that need to be on the market for it to have equilibrium. And a report this week said tariffs could tack on some $6,000 to the cost of building a new home. How long are people going to sit on their cheap mortgages from COVID? Thank you very much. And before they move on, before the market frees up.
So you have several things there. The first is we just haven't built enough housing, and we haven't kept up with the demand for housing. So there's an underlying shortage. Before the pandemic, there was a real housing shortage. And by the way, that's happening in many democracies around the world. The second thing is, lock-in, as you say. There were very, very low mortgage rates during COVID, and people are kind of locked in. It would be very expensive to move, and that'll of course wear off over time. You also mentioned, the costs of materials that might be imported, lumber and nails and things like that. And yeah, that and also labor, a lot of labor from in the home building business has been traditionally immigrant labor. So yeah, the sort of new build market, it may face some cost pressures as well. That may very well be the case. That's what we're hearing from home builders, for example, both on the labor side and on the materials side. But even once these short-term things happen, we're still going to have not enough houses. And so it's all, I think for a long time, we're still going to see upward pressure on housing prices, maybe until population growth slows or until we catch up.
You mentioned that we're kind of in a period of waiting right now to see how policy ripples out through the economy. How long do you expect that to take? How long do you expect these big policy changes to show up in our day-to-day lives, in prices and supplies and things like that?
I mean, for a while, we didn't know what was coming on April 2. Now we know what came on April 2. We don't know. There's a lot more to be said about how all that shakes out. But we've come through that, and I think you now know that the tariffs are larger than people were generally expecting. That much now at this point. And you'll know more as you start to see the effects on the economy. So as the months go by, it's hard to say exactly when you'll know. But clearly that learning process is ongoing. We're just seeing that these are new policies, not just the tariff policies, but the other ones as well. There'll be important fiscal legislation coming up fairly soon, and there'll be regulatory changes, significant regulatory changes. You have to really look at all of that to see what the overall effect will be. So I can't give you a date, but all of that is now kind of coming into place at sort of the speed you would expect policy changes to be, and then we'll begin to see the real economic effects as the year goes on. But again, I can't give you a really specific date. Is
the fiscal legislation the tax cuts?
Well, yes. I mean, I know they're contemplating, and again, we don't comment on fiscal policy, but what I read is that they're contemplating, making the Tax Cuts and Jobs Act cuts permanent, and also perhaps some other things as well. We wouldn't be. We have a sort of a placeholder for
Fixing the mic.
That's really not ours to comment on, but that's what I was talking about. Yes.
Maybe. Still crap.
So I have a question from a friend in Milwaukee who said she has clients that have deals ready to go, businesses that are ready to launch from their garage to a private equity deal, and they're just stuck in their garage right now. How long do you think, what do you think the impact of the uncertainty these days will have on the private equity deals?
So again, we're hearing a lot of that. People are they're just kind of waiting for clarity, waiting for clarity. So, and I can't tell you when that will pass, but ultimately it will pass. We know that at a certain point we'll know enough to know what the uncertainty will decline, and we'll be able to see with real clarity what the policies are and what their effects are. So, you're right. We hear the same thing from businesses and from people that they're kind of waiting and seeing. There's a lot of waiting and seeing going on, including by us, and that just seems like the right thing to do at a time of elevated uncertainty.
What economic indicators are you watching right now? I mean, very famously, you look at the CPE and obviously the CPI and things like that, but are there any economic indicators
PCE, lady, PCE.
you are watching, focused on?
Sure.
Interested in?
So the basic two big data pools are the data around prices and around employment. And we get in the employment area, we get just really that's an area where we actually get pretty good data. Although the survey response rates have been lower, nonetheless, we get a lot of different data. And it's not just unemployment, it's participation, it's by age group and things like that. It's wages, it's many, many different things. It's jobs, it's quits, all the job creation, quits, openings, all those things. So that's one thing. On inflation, we target PCE, personal consumption expenditure inflation, not CPI, and the two are broadly they move they move together. But 25 years ago, the Fed switched to PCE. The public looks at CPI. It's kind of a little bit of a thing, but because we think it's really just a better way to capture the inflation, the cost pressures that households and businesses feel. We think it's a better measure, and that's what we look at. But they're not that different. I mean, they look at different measures. Ultimately, they're pretty close together. Those things. On growth, you look at what's happening with consumer spending. The economy is overwhelmingly driven by consumer spending. So you look at how are consumer surveys, how are they feeling, how are they spending? Sometimes the surveys are very negative, but they keep spending. That's been happening really for a while. People spent right through the pandemic, and they spent right through this time of higher inflation. They kept spending, and forecasters kept thinking, like us, that consumption would slow down. But that's a really critical thing. After that, business investment is a big chunk, and you look at that, and that is also susceptible to sentiment. Businesses, if they don't know what to do, they're not going to do an acquisition, or they're going to hold off on building a factory or a plant or hiring people and things like that. So we look at, I could go on for a long time. We look at a lot of data, and we try to make sense. We also talk to people who are in the real economy. I grew my career was mostly in the private sector, talking to people who ran businesses, and for me, the story doesn't come together until I actually hear from people who are in the economy doing things and what they're feeling and seeing, and then it sort of fits together better.
This is like via the Beige Book, or just
Beige Book. Thank you for mentioning the Beige Book, and I hope you read it.
I love the Beige Book.
See, that's great. Everyone should read the Beige Book. The Beige Book comes out sort of mid-FOMC cycle, and it's all the 12 reserve banks and all of their incredible context, what they're saying about what's going on in the economy. So if you want to know, you can look at the national data, but if you want to know what's going on in regions and at different industries, you look at the Beige Book. So it's really a critical thing. And actually, the reserve bank system that we have is an enormous strength of the Federal Reserve System. We have these 12 reserve banks with their own, economics departments and own participants on the FOMC. So that's a great thing to look at.
I'd like to ask you about another body of work that many of us know that you're familiar with, and that's the Grateful Dead. So, question for you, sir. American Beauty or Terrapin Station?
American Beauty.
Well, it's not even a
Not even
pause.
close.
That was
Ask me a
so
hard one.
fast.
Working man's,
That's my era. That's my era.
working man's dead?
Yes.
Or Europe 72?
Oh, both. Yeah,
come
that's
on.
my era. We're in the same era here. So that's, for me, it's late 60s to mid 70s. So you're.
Touch of Grey, what do you think?
It was their only hit, but it's a good song.
Okay.
Yeah.
This is awesome.
We're going to do this?
I feel like you're speaking another language.
There's a well-known Grateful Dead bootlegger who, with the, I believe the permission of the band, Dick's Picks, who's put
Yeah.
out. So what's your recommendation of those hundreds of
I
Dick's Picks?
don't have any Dick's picks. Like I said,
Come on.
my real interest was late 60s
What?
to mid 70s.
Somebody
I saw them a
clip
bunch of
that.
times, and I know every note on every song from that era. But since then, I've been busy, actually.
Well, we thank you for taking time out of your schedule to join us here, and we appreciate your work.
Thank you very much. Thanks, everybody.
All right. Jerome Powell has no Dick's picks, not to be confused with something else. Okay. Anyway, let's do a full summary here of what's going on. Remember, the non-accredited investor round is live over at househack.com. If you haven't heard about it yet, go check it out over at househack.com. Check out all of our properties, financials, before, afters. We think with the cash position we have, we're doing really, really well going into Q3, Q4 buying opportunities here. You get 100% of the upside in the stock, and you get 5% per year with downside protection. Check that out. And then also, for those of you who want to be part of these course member live streams we're doing every morning, where we're talking and doing fundamental analysis on things like restoration hardware, when the buy time is for restoration hardware, what the risks are for companies like that, and price targets. Make sure you join us in those course member live streams. Meet Kevin membership. You get all the courses, every private live stream, every alpha report every morning. This morning we called the Qs going down to 431 on the downside, blowing right past 435. Didn't even mention 435. So I suspected it was going to go right through it. You can check that all out for a 30-day trial if you want. Very low monthly price. Go check it out at meetkevin.com. And let's get into this summary here. So, and those prices are going up April 15th, by the way. So we got another 11 days before those prices go up. Okay. Time to get into the full-on summary. All right. Are we rolling? Yes, we're good. Okay. Well, it's official. Jerome Powell just told us exactly what we thought we were going to hear. There is time to wait. This is not what the markets wanted to hear, but it is what we expected to hear. Despite Jerome Powell being begged by Donald Trump to please cut interest rates today, Jerome Powell says no. We have plenty of waiting to do. And this comes on a day when we are now hitting the highest volatility we have seen since the Japanese carry trade in August. We have the highest buy the dip volume in a decade, with $4.7 billion of buy the dip on Thursday per JP Morgan, in contrast to what hedge funds are doing. People are buying the dip like crazy right now. Whereas guess what hedge funds are doing? Hedge funds on Thursday, same day, yesterday, sold global equities on a net basis, long short, so netted out, the largest one-day level of selling since 2010. So in other words, in 15 years, hedge funds have sold the most yesterday, and retail bought the most in a decade. What a crazy tale of two cities here. Buy the dip on one side and getting the F out, GTFO, on the other. And we really saw this. If you looked at the market close yesterday, the last hour was basically straight down. Often when you see a lot of that institutional trading taken off. One thing you're not seeing take off just yet are flows into inverse ETFs. So we're going to watch those because usually that could be a sign of peak pain when people max out their bets on those. Now, we're going to talk about all the details of what Jerome Powell just said, but some things to pay attention to in terms of what's news right now is there are estimates now that iPhones are going to go up from $1,000 to $3,500 due to tariffs. The Tax Foundation thinks the average American family will be paying $2,100 more per year due to tariffs, and they think GDP is going to shrink by 0.8%. Klarna is pausing their IPO due to this, tariff turmoil. Kind of a terrible time to IPO. It's one of the reasons for HouseHack, my startup. We were going to go public in January, and I had a really bad feeling that things were going to get a little poopy in Q1. So we canceled our HouseHack IPO. So we're like, I don't want to IPO during a really crap time. And look what ended up happening. Knock on wood, we can time it like that again in the future, but except on the upswing. Republicans are also considering a 39.6% tax bracket on those making over $1 million. And so far, Bitcoin's holding up pretty well. I think some of this might be because of MicroStrategy buying. But anyway, stay tuned. Now, before we talk about Powell, we need to talk about this Vietnam news, because Nike and Restoration Hardware had a little bit of a boost after Donald Trump commented that the General Secretary of the Communist Party of Vietnam wants to cut their tariffs down to zero if they're able to make an agreement with the United States. The first thing that you have to know about Donald Trump, though, is remember, he's a salesperson. And something that it happens a lot, especially in real estate negotiations, is you'll get an agent call and go, hey, man, all the other buyers are coming up in price. You gonna come up in price? Right? It's sort of like a way to get everybody to bid against each other. So because this news is coming from Trump instead of directly from Vietnam, there's a little bit of an asterisk on it because of the salesmanship that could be coming from Trump's POV on Vietnam to encourage other countries to start bending the knee, right? Once one does, maybe all do, is sort of the thought. Now, something else that you have to remember about Vietnam is we imported about $123.5 billion from Vietnam to the United States. They only imported from us $26 billion. They had average tariffs on our stuff at about trade weighted at about 1.1%. Okay, so 1.1% on 26 billion is what they would give up if they get rid of their tariffs on us. We have a 46% tariff on their $123.5 billion of goods right now. So obviously, there is also the argument that Vietnam stands to benefit a whole lot by getting rid of their 1.1%, which, maybe that was the goal all along. It just puts everybody through some real short-term pain, and that's obviously why there's so much buy the dipping, because people believe that this is just going to be a short-term negotiated strategy to not destroy the economy, but rather to negotiate 0-0 free trade. Who knows, because we're not entirely sure how that 0-0 free trade is going to align with this idea of bringing manufacturing back to America. We had a big discussion about bringing manufacturing back to America this morning in the course member live stream, and we're looking at some of the arguments on both sides of this. Long and short, it's very difficult to compete globally, and so there would take a lot of infrastructure, industrial expansion, and training in the United States to actually bring this back. China obviously had retaliation this morning, and then we're going to talk about Jerome Powell. China's 34% retaliation this morning is significantly more calculated than what we imposed on China, because they're purposefully, in addition to that 34%, trying to hit us where it hurts. They hit 7 rare earth exports that they're now restricting to us. Really important to remember that China controls 60 to 70% of supply of of rare earths in the globe. I'm going to butcher some of these names, but whatever. Samarium is used in magnets, motors, nuclear reactors. Gadolinium, whatever, is used in MRI/LED lighting, so for contrast colors. Terbium is used in LEDs. Dysprosium is important in electric vehicles, wind turbines, high-performance magnets, motors. Lutetium, medical imaging, petrol refining, some electronics and scandium, aerospace metals, as well as yttrium, whatever, superconductors. These are important battles. They're trying to hit Trump where it hurts, probably also their version of negotiating. But restrictions on these rare earths, when China basically controls 60% of the supply, is problematic. This is one of the reasons why Donald Trump wants a critical minerals deal, not only in Ukraine, but also wants Greenland, because Greenland is expected to have access to somewhere around 40 different critical minerals, though obviously mining over there is a little bit more challenging just because of the weather. Now, as far as Jerome Powell, there were these really large expectations today that Jerome Powell was going to come in and cut rates. In fact, I've been responding to tweets on X, and I hate doing this because it's so one-sided on X. It's a very right-leaning platform. And you know me, I just look at the facts and reasonable data. I don't care about your politics. But there's so many people on X that are getting all these likes and retweets because they're like, Powell should cut rates. And this was before Donald Trump even said Powell should cut rates, though we know that's what he wants. People are like, Powell should cut. Powell needs to cut. Powell needs to cut. And everybody's like, yeah, Powell's going to cut. And so I think there was some expectation that Powell was going to announce some cuts today. That's insane. Of course he's not going to do that. He's totally stuck in a rock and a hard place. He had job data this morning that actually reiterated that he should hold higher for longer. I mean, consider the job data this morning. We came in at 228,000 jobs versus the 140K expected. This is great. Absent tariffs, this is actually good news. This is fantastic news for the economy. Now, we did have a minus 34 on the 1-month revision. The 2-month revision is minus 48, still a great read. We had 20,000 workers coming back from strikes, and we had some state and local government hiring offsetting DOGE-related firing. We also had warmer weather in March, so there are potentially reasons why we saw almost all sectors, transportation, retail trade, social work, healthcare, move up in hiring rather than down. There's also this idea that there's a lot of pull forward of demand. We need more workers now to get ahead of the tariffs. So the jobs data was really good, though. I mean, you could say bad things about it, but it was a pretty good jobs report overall. The problem, though, is Jerome Powell is destined, and this is what he talked about, he's destined when it comes to a choice between jobs and inflation. He basically implied that they're going to go for supporting the jobs market when and if the jobs market actually breaks. So far, there's no sign of the jobs market breaking, so they can focus on inflation, which is running around 2.5% on PCE now, and is expected to rise to 3 to 3.5% after these, quote, larger than expected, that's what she said, tariffs. The thing about Powell is when Powell reacts and capitulates and we start seeing rates actually come down from Powell, it's going to be in response, very likely, to the job market faltering. The problem is, by the time the job market falters, it's probably too late because it's going to take a lot of time for those lower rate cuts to actually work their way through the economy. And so we probably are already in a recession by the time they turn around and cut. This idea that the Fed can preemptively cut, I think, is misplaced. Markets right now are pricing in 4 rate cuts for this year. That's double what we were pricing in a month ago. Mind you, a month ago, markets peaked out, right? At the end of February is when markets peaked out. That's when my fund gave people $40 million back and said, be careful, we're about to go into a poop show, after returning 25%. If it was still open, we'd probably be substantially outperforming right now because the holdings we have or had were very well positioned for rate cuts and hedging. We were on triple leverage bonds, which have been skyrocketing over the last month. We were on mortgage companies like Rocket Mortgage, huge holding, which is skyrocketing now, and they're pulling amazing things off with their acquisitions. We've been talking about those in the Meet Kevin membership as well, some of the acquisitions and the longer-term implications of where the value of Rocket Mortgage actually sits right now is. And is it a buy-the-dip opportunity in this market? Anyway, Jerome Powell, see that at meetkevin.com, by the way. Many of you already know the price is going to go up on that Meet Kevin membership on April 15th. If you lock that membership in now, which is less than $1.70 a day, you will lock that price in forever. If that pricing goes to, say, $3 in the future per day, you've locked in $1.70 forever. So consider that over at meetkevin.com. But anyway, Jerome Powell, it gets you all the courses, all the alpha reports, all the lectures, all the live streams we do, the course member meetups, you name it. But anyway, Powell made it very clear that with jobs holding up, it's not really necessary for Powell to even consider cutting right now, and instead, it's important for them to be very patient. He says, quote, it's too soon to do anything. We are well positioned to wait for greater clarity before considering policy adjustments. Tariffs are likely to rise as raise inflation in the coming quarters with more persistent inflation possible. Now, this is interesting because it's a total flip-flop from what we heard like a month ago when Powell's like, tariffs might end up being transitory. And then everybody's like, no. He's bringing transitory back. No. It's already gone. It's already over. It already looks like a joke. So it's clear to the Fed that the tariff effects will be significantly larger than expected, that the outlook is highly uncertain, and the obligation to make sure these one-time increases don't become continued price increases is high. And while the jobs market and the jobs data today tells the Fed, you have no rush, Jerome Powell's just going to sit back and go, I guess we'll just wait and see. Hey, by the way, I like purple ties. Why do you wear purple? I like the tie. He told us that today. Although then he did say, should I wear a red tie? Nah. Should I wear a blue tie? Nah, I'll stick with purple. So politics sort of reaffirms his belief, which is not a surprise. We've all known that anyway. But anyway, this idea that the Fed's going to be focused on, the dual mandate. Well, of course. And what does the dual mandate tell the Fed to do right now? Nothing. It's that simple. So this idea that people, and I've been saying this in the course member live streams and actually on the channel, don't expect Powell to bail you out this week. He ain't going to do anything for you. He's not going to do anything for you for a while. Markets are pricing in a 36% chance of a cut in May. I think the chance of that is 0. Although we'll see what happens between now and then. Markets are pricing in the first cut for June, fully priced in. Markets are pricing in a second cut in July, fully priced in. And markets are pricing in 2 more cuts by December, fully priced in. You have 4 cuts fully priced in right now. This is happening while we're seeing some, inflation expectations start creeping up. And Jerome Powell does make it clear that the consumer is critical to our economy here. So, are people going to stop spending? We don't know. People spent during COVID. People spent like crazy after COVID. People just say they're negative, but then they keep spending and the economy keeps going. So maybe that's a bullish reason to keep buying the dip. I mean, I actually think the best coupon code ending ever is not the fact that at some point we're going to close the fundraise for House Hack, where you get, 5% yield, diversify away from the crazy stock market. You get upside, all of the upside in the stock, 5x, 10x, 2x, whatever ends up happening with the company, 100x. You get all of that with downside protection. It's a really cool offer over at househack.com for diversifying, read the PPMs and circulars. But beyond that, what's a really amazing coupon code is this idea that, hey, buy inventory now at companies like Restoration Hardware, or buy a car inventory now because it's not yet subject to tariffs. Interesting. I mean, just this morning we heard that the Nintendo Switch pre-orders are being delayed because they're not sure they're able to price it at the same price anymore because of the tariff drama. Nintendo Switch 2 doesn't come out until I think it was June 5th anyway, so I guess there's some time on the pre-orders, but we'll see. Jerome Powell says he's frequently in contact with other central bankers, and sort of he's jokingly asked if they have a group chat or a signal, and Powell says they're not at liberty to say. And then when it comes to housing, Jerome Powell nails it here. Jerome Powell says the problem with housing is most housing markets in the United States, not all of them, there are definitely overbuilt housing markets, but most housing markets in the United States are underbuilt, undersupplied, and this creates this sustained housing value, and that, in my opinion, that's what's so desirable to what we're doing at House Hack, because you're diversifying away from this craziness into where there's a housing shortage, and then obviously upside in what we're doing as a company beyond being backed by over $60 million of actual real estate. Anyway, so this gives you a breakdown of the jobs data and Powell, but I want you to relate this to what's going on with tariff negotiations. Remember that the biggest tariff negotiations we need to pay attention to are the European Union, which we still haven't seen the countermeasures there, and they're expected to be quite big, including potentially $1 billion fine to Elon Musk for spreading misinformation. That's interesting. Topic really for a different video. But also this idea of China, like how are we going to negotiate with China? Vietnam is relatively small when it comes to our total trade. Our total trade in terms of imports sits somewhere around $4.4 trillion that we might actually be able to tax. And $26 billion of imports divided by $4.4 trillion is less than 0.5%. So this idea that, Vietnam is solely good news, that's not the big player you want to pay attention to. You want to pay attention to the big players. Actually, I'm sorry, it's a little bit more. 123 is what we import, divided by 4.4. Vietnam works out to about 2.8% of our imports. Sorry, let me correct that. But we want to see the big players. And we still haven't heard from Vietnam themselves. This is Trump's POV. It's a good sign, though, that Trump is willing to negotiate, even though he kind of keeps telling us that he doesn't want to negotiate, wants to bring manufacturing back to the United States. I think everybody's pretty convinced that this is all just a big negotiation to try to get to 0-0 free trade, and then we're right back to free trade. At least that's the hope. If we really are trying to bring manufacturing back to the United States, probably going to go through a dirty recession. And then you could pull it off, because then you could subsidize the manufacturing in the United States as a form of stimulus, industrial work programs like a new Works Progress Administration or whatever. Oh, interesting. U.S. judge rules Trump administration violated court order by freezing FEMA grant funding. Interesting. So anyway, we'll see where it goes. If you want my trade alerts or commentary on the market and the course member live streams, you want to be part of the course member meetups and be part of a rational community. We're not like, we're not going to put left thoughts down your throat. We're not going to put right thoughts down your throat. We're agnostic to politics, and we're just trying to provide perspective. If you want to be part of that community, join over at meetkevin.com. And then, of course, if you want to diversify away and earn 5% per year, you get paid monthly, by the way. Go check out househack.com, because on top of that 5%, you get all the upside we're able to pull off over at the company. And boy, we think we are gloriously positioned for whatever the heck happens in this economy. So we kind of think we're almost like a counter-cyclical trade at this point, which is really exciting. So anyway, thank you so very much for being here. I really appreciate you always watching. Whether you're on live or watching the videos, I always appreciate you being here. Appreciate the support. Always leave me your comments and perspectives. Whether you like me or don't like me, I hope you appreciate the perspective. And we'll see y'all in the next one. So thanks so much for being here. We'll see you. Bye. Now I have to figure out where the off button is. I know where it is. I just have to get there. Good luck.